So we have Paul Tilyaev here to join us. He is a seasoned accounting and finance professional and CPA. He's passionate about providing holistic client service, being a trusted advisor to business clients of all sizes. He has industry and public accounting experience, including with multi-billion-dollar companies and Big Four accounting firms like PwC and Deloitte. Paul founded his firm Perpetual CPA in 2016, and he's currently the managing partner. So welcome, Paul. We're so excited to have you.
Thank you for having me, Liza, and good afternoon to the audience.
So why don't we jump right into it? I know you've got a number of things for us to cover in our time today.
So the four key topics that we'll discuss today. So one is cash flow management. Second one, payroll management. The third one, is usually an important item as well, is legal entity options. And then we'll round it up with a bit of information about, when is a good time to hire an outside accountant, and basically, what the options are for that as well. So cash flow management is by far the most important topic for most small businesses. Especially, that's the most frequent cause of death of small businesses, right? So it's worth always being mindful of it as well. The recent survey was done by US Bank, and they basically concluded that 82% of small businesses fail because of poor management of cash flow. When I talk to clients, a lot of times it helps to bring an analogy other than accounting. So after working for a while with small businesses, it kind of became a habit, right? So try not to talk accounting language to business owners, but, bring in other analogies. For example, think of it, cash flow is the oil in your engine, right, of the business, right? What happens to an engine when the oil runs out or leaks out? It seizes, right? And you're done. So the same thing essentially happens with businesses, right? So it's what makes the business go on. And the technical description, right, definition of what the net cash flow analysis is basically it's a continuous process where you're monitoring all your net cash flows in and cash flows out, right? Basically the funds that are spent on expenses. And some of the biggest errors that a lot of, especially early stage businesses make, having to do with, sort of wasting their working capital, right? So, which is their liquidity, on things that are not necessarily important in the beginning. And that's typically happens because of, somebody they know said something that was a good idea, but, eventually find out that it's not.
Do you, Paul, have any specific examples of, the kinds of things that are spent on that maybe don't need to be spent on early days?
Right. So, well, the number one thing with any new business, right? So you want to first have a solid idea of what your service or product sale process is, right? If it's something that you can replicate over and over with success. Right. So if you're working on projects that are one-offs, right, so then it's going to be really difficult to justify investing a lot of cash into expansion, right? The problem with that is pretty much every small business starts out with out-of-pocket capital, right? So if you're starting a business, the first person who's going to put money into the business is typically yourself, and then your, friends and family, essentially. And that's the money that's the closest to you, right? That you want to probably not risk as much as, say, bank's money. But the thing is, if you start, say, buying up equipment, right, because you think, okay, I've done a few projects here and there, but the projects were basically one-offs, and you start buying up all the equipment, right, what's the guarantee that you can actually use that equipment enough on enough projects to justify capital outflow? Because once that capital is gone to buy the equipment, you're just stuck with the equipment. And, what if you have a different project that doesn't fit your, say, current setup, but your cash is gone already? What do you do at that point? So the important thing to keep in mind, especially in early stages, right? Number one is make sure that your revenue generating process flow is solid and to the point where you can repeat it multiple times, because then you know what equipment, for example, you need to have, right? So in order to keep growing the business. But even then, right, so expansion is usually the next big mistake that many small businesses make, right? Say, assuming they determine what their repeatable process is. Say you have a flooring business, right? So all you do is just you install floors. You don't spend your time doing things that are not necessarily your core competency, right? Because that would require different equipment set, you know, things like that. So, and then also people know you because you are making floors or installing floors. So even in those situations, right, so businesses usually come to a point where they sort of coasting, right? So they got the equipment that they need to do the projects, but, you know, they typically hit capacity, right? So say if it's a one-person business, you know, he or she can probably do like, you know, 2 or 3 projects a week, right? But then pretty soon the word gets out. If they do a great job, you know, they might get, you know, 5 or 6 requests per week to do a job. So what do they do at that point? They have to think about expansion. So the thing with expansion, right, that many businesses also sometimes don't think ahead of is to expand. A lot of times you have to commit, right? And commit in terms you have to hire additional staff, right, who will do the work, buy additional equipment, right? So, you know, there are other administrative expenses that increase. And a lot of those expenses are fixed, right? Once you commit, you have to pay it every month, no matter what, whether you have the cash inflows to cover that or not. So those would be sort of the most frequent and typical examples, right? When you know, hasty spending can hurt the business. So, but say, you know, you thought of it, you're handling your expansion, you know, slowly enough where your actual sales are catching up to your fixed expense commitments, right? So the next thing that comes into place is doing the analysis, right? So are your cash inflows sufficient to support your business and then also help you get to the next step, right, in your business growth? And for that is, you know, that's when you start analyzing things, you know, like cash flow conversions. Because there are instances where, say, you've done a project, like, for example, maybe not directly to a customer, but say as a subcontractor project, right? And the other contractor who's running the project keeps telling you, oh, I'm going to pay you in a week or in a month or 90 days. So what happens is then you made the sale, it shows up on your profit and loss statement, but you don't have the cash. So it's important to realize that not all sales equal cash, right? So at that point, this is where, you know, shortening cash flow conversion, what it means is basically when you convert your service to actual cash. So the smaller that period is, the better. So typically when
yeah, and I know, you know, with House Pro, we are trying to advise folks to use online payments, whether it's for clients or for paying, so that they're doing, you know, bank transfers or collecting credit cards, so that they don't have to wait for checks that are theoretically in the mail. Are there other techniques that you see other than kind of the convenience piece that help people shorten that cash flow conversion cycle?
So in construction, it's also typical to do milestone billing, right? Especially on larger projects, right? That's, you know, like say if you're doing a large commercial construction that can, you know, run, you know, from one year to the next year. So typically you have contractual agreements, right? So where, you know, this is a total project cost and this is how the billing is going to happen in stages. So what it allows is essentially when the project starts, the builders, right, or service providers, they typically experience some sort of cash outflow, right, into raw materials, right, maybe additional help or seasonal help, maybe additional specialized tools and things like that. So you don't want to have to carry that cost on your books for an extended period of time. So that's kind of when milestone billing happens. But with a lot of smaller builders, you know, depending on what you do, right, like for example, again, same example, like a floor installer, right? So I know they can typically complete a project within days, right? So, and then if they're dealing directly with the homeowner, right? So that service to cash process is very quick, typically. But in instances where, you know, say your company is involved in home remodeling, right? So yeah, the process can get extended quite a bit, right? So, you know, typically you can plan for 60 days, right? If you have a good team, but it can potentially extend beyond that, because one, especially when you're using things like bridge financing, right? So, and then, say the market changes, right, while you're remodeling. So those type of things that can really blow up somebody's budget. So, and that's kind of getting to the next point. It's important to have a budget because it does several things, right? Typically, you can think of it the same way as people would think about personal finance, right? It's really scary, right, to see how many small businesses don't have that cushion of safety in their businesses, in their books. A lot of them really operating sort of, to the maximum extent of their working capital. So what that means, should something not go according to plan, they're going to feel a lot of pain from that. So, and typically, the businesses that do plan ahead and have a budget and stick to it, essentially, but then also budget in, working capital safety, because you would, like every business, almost every industry has its phases, right? So you have, good times and the bad times, right? When you have a lot of demand for the services and not so much demand, seasonality. So, and being able to ride out those longer than your competitors is going to be potentially critical to saving your business, right? Compared to, others who didn't plan for it. So that's why sticking to the budget is important. And then the last item to note about cash flow, right? So again, unfortunately, we see a lot of the times when businesses start looking for additional financing because they failed to plan for the cushion. And they kind of fall into this situation where they need help the most when they can least afford it, right? Because they didn't plan ahead for it. So there are two morals, right, in that scenario. One is seek financing when you don't need it, because that's when you can get the best terms. So
you're saying put it in place even if you don't need it. You don't have to use it, but it's there for you to tap into when you do get into a situation.
Right, because if you think about it, you started a business, right? You finance it out of pocket. You finance it with, maybe you borrowed some funds from friends and family, right? And that's your working capital. So essentially, you and your close ones are playing the role of a bank for your business. And that's your working capital. So, but businesses, 82% go out of business, right? So I'm pretty sure some of them tried to plan ahead, but still, right? Something outside of their control destroyed their business. So do you really want to have your business running on the capital of your, family and friends? Or would you rather have, bank take the risk, right? So once you get the business up off the ground, right, it's a good time, especially when your book's looking good, right? Your book of business looks good, right? You don't have any shortfalls in cash. That's a good time to go find financing, because what you can do is just like replacing oil in the engine, right? So you take out the old oil and you put in the new oil, but except you're taking out the old capital, give it back, preferably with some interest, right, to your friends and family. And then you're essentially taking out all of your own risk out of business that way. And then the bank takes on additional risk. Because the thing is, if you, I see a lot of businesses actually find themselves in that situation when they need it the most, they can, they're in a situation they can least afford it. And also they wait till the business gets into trouble, right? And then net income turns into net loss. The thing that a lot of business owners don't realize, you can have the greatest projections, right? And sales forecasts that'll say that in a year or two, you're going to make millions and millions, but banks don't care. They want to see historical and current financial statements that show positive cash flow, especially if you're looking for term loans, right? If you're going to do some significant take on significant projects, right, where significant financing is needed, term loans is typically, what businesses would turn to. But for term loans, but if at that time your profit and loss statement is showing negative income,
not going to get the money. Yeah.
No, because the bank sees, right? Like they're going to ask you, well, if we give you the money, how are you going to make our payment if you don't have any additional cash flows? You can't. So, and at that point, they will try to look at other alternatives like personal assets and things like that. But then do you really want to risk your personal assets at that point? So, So again, don't wait for the bad times. Kind of try to plan ahead. That's the moral of the story.
Yep. Make a budget, get financing in place. Yep.
Yeah.
Great.
So payroll is another big item to consider. From working, so we, in our practice, we work with a lot of small businesses. They are our core clients, and we support them on, three major service lines, right? So one is accounting, two is tax compliance, and three is general business advisory. So we see pretty much everything from A to Z what's happening in their businesses. And a lot of times clients get confused between their income tax compliance responsibilities and then their payroll tax responsibilities. So, it's important to understand the differences, right? So typically, these conversations starts when clients get letters from the IRS, right? Typically. And all of a sudden they think it's, income taxes related, but you have to read the letter carefully, right? So, and I'm saying this because almost every small business at some point is going to get a letter, and it's just how it is, right? Small businesses, they're typically having more fluctuations in their, finances and cash flows, and sometimes they do end up having with lapses in their payroll, either due to not getting help in time. Or just, not knowing enough about the process. And there are certain things that are different when the IRS asks about payroll taxes versus income taxes. So for the biggest thing is that I tell the clients, right, if you're going to get a letter about your personal income taxes being late or due or something is wrong, the first letter you're going to get from the IRS is going to be a pretty nice letter. And then if you ignore it after, a few periods, right, or iterations of those letters, they will progressively get meaner and meaner to the point where we'll say, okay, we're just going to take the money out of your bank account. But it's going to take a long time for that. When it comes to payroll taxes, there is no this sort of grace period of niceness from the IRS, right? They start mean right away. And the reason for that is it's what's called trust fund recovery. Basically, the business owner, the employer, is holding the funds that they withheld from the pay to the other taxpayers who are their employees, and they're holding that money on behalf of the IRS as a trust, right? So, and when they don't transmit these taxes to the IRS in time, IRS gets angry really fast, and they start treating it almost immediately, almost equivalent to a criminal offense. Not just like being late in taxes, criminal offense, because that's almost like fraud to them. That's why they the letters start out mean right away. So, and that's why it's important to understand, right, the difference between those taxes, because sometimes, business owners also ignore those letters, right? One thing to remember, every time you get a letter from the IRS, there is a timer on it. And the timer usually about 30 days. So if you don't do anything about it in 30 days, especially with payroll taxes, it's going to get even worse very quickly after that.
So don't ignore them. Don't
exactly.
put them in the later pile. Yes. Okay.
Yes. And even in, individual income taxes, right? So if you get a notice, definitely don't ignore it. Take it to your tax practitioner ASAP so that they can advise you accordingly. But some of the forms that business owners should understand, right? Because I hear a lot business owners saying, oh, I need to pay quarterly taxes, but they don't even know what that means, right? So they think they're paying quarterly income taxes or maybe estimated taxes. But payroll really has only several forms to really, that every employer should know about, right? It's Form 941, which is a quarterly payroll tax return filing. So which is filed 4 times a year, every quarter. Then there is a Form 940, which is an annual, it's usually a federal unemployment insurance tax filing, essentially. And then the Form W-2, which is what employers have to issue to the employees at the end of the year, right, so that they can file their own taxes. And then there is a Form I-9. I-9 is not a tax form. It's actually form of the Department of Justice, and it relates to the immigration laws. So it's basically the form where the employee certifies that they have the correct immigration status and they have the right to work in the United States. And that's on the employer to check that form, right? Because if they don't check it, they might end up, again, in trouble with the Department of Justice because of that. So those are the main forms to know about. Another important factor is also understand the relationship between employee and employer. Because especially in the construction industry, so there are instances, there are local regulations, right, that some, also require, not hiring independent contractors, right, unless they have their own builder's license, typically. So what it leaves with a lot of small contractors, right, when they're not able to hire another contractor with a license, right, for many reasons, right? So they just hire either lesser experienced employees or non-experienced employees who they train. So at that point, they hire those employees. What happens when you hire an employee? It kind of goes back to our previous slide, right? It's a commitment to fixed expenses. You're going to have to pay their salary essentially, ongoing. Well, of course, unless they're hourly, but then it also depends on the agreement, right? So if you don't have any work or projects to give them in a specific pay period, did you guarantee them minimum wages to be available at all or not? So those are type of the things to consider, as well as, and that kind of goes into being in compliance with the tax and labor laws, essentially. So knowing your forms and knowing what constitutes an employee-employer relationship. So payroll in itself is not very complex, but it typically pays, if you're going to have employees, no matter how small your business is, it typically worth the money to pay a payroll processor to process payroll.
It is. Okay. We get that question a lot. So that's good to know that it's worth
yes,
having.
Because we meet a lot of smaller business owners who elect, like Intuit payroll service, for example. They have this payroll. It's called do-it-yourself payroll, where employers have to, run the payroll themselves, and they have to kind of manually run all the form submissions, like Form 941, 940, W-2, everything else. The problem with that is small business owners are not used to doing it regularly, and they don't know exactly what the ramifications are, and they typically think something else is more important. So they fall behind on it, and that's when the angry letters start from the IRS.
Right.
But they do all of that so that they can save maybe, 20, 30, 40 bucks a month. So is it really worth that? I say no. So to me, like from my professional experience and, my opinion is paying a payroll processor, yeah, you probably pay like 20, 40 bucks a month more, but it's going to save you so much more headache. It's totally worth it. Because payroll processors, so over a period of time, we've worked with many processors. So now our typical go-to processors that we usually set our clients up with is ADP, so they're a national organization, and then Gusto is another. Gusto is more of an online provider. So both of them are really good. They have very good customer service, and their fees are pretty competitive as well. But the value that comes from working with them is to the business owners, right? So they will file Forms 941 every quarter. They will file Form 940. They will issue and provide Forms W-2 to all the employees. Employees will get, automated access online so they can download their W-2. So you as an employer don't need to do pretty much anything other than run the payroll, right? And if you're paying the same amount to the employees every month or every 2 weeks or however often, you can even automate it. So that means all you have to do is just make sure you have enough funds in your payroll bank account to pay that, and that's it, right? And then also they have additional setup like Gusto, for example, where you have a new employee. All you really do as an employer, just send them an email, enter the email, and then the system sends an email where they enter their W-4 information, which is, how many allowances they will have, to withhold taxes from their paycheck. And then they also fill out the Form I-9 and upload their driver's license and everything else. So then you as an employer, all you have to do is just go in, review it and check. And then you're in compliance with tax and labor laws. So great benefit for very inexpensive service that way.
Does it keep the payroll records for you as well?
Yes. So that's another good thing about it, is that they typically maintain, it varies from service to service, but they will typically maintain, I think up to 3 years of payroll records. But typically it is recommended that, so one thing to note for business owners, if you're setting up payroll, you are the payroll administrator. Even if you have, say, a support person within your business who enters the hours and runs the payroll every period, right? You as the business owner are the payroll administrator. And what that means is if there is a lapse in, say, filing Forms 941 or remitting taxes withheld to the IRS, you are the person who the IRS is going to go after. And typically, I've seen that happen, unfortunately, right? Where businesses goes under, but the owner never, paid off, remitted the taxes withheld, and then they become personally liable. And if you have a big team of employees, that liability can be significant. So that's something to keep in mind. That's why, again, it's important to have the payroll processor, because they make sure those taxes are remitted timely every period. So again, really worth the service. So, and one other thing too, even though payroll processors, they'll typically have the tax documentation available for, up to 3 years, I believe. It might vary. I still recommend payroll administrators to download that documentation and maintain it on their local drives or cloud drives, whatever they use, right? So basically off the platform, because anything can happen, right? Platform can, go down and you need those files for something. So duplication of those files is typically recommended. And then the last thing, again, consider outsourcing payroll, right? Because, first step of outsourcing, right, is working with a payroll processor. But then there is another thing, is actually managing the payroll. It's, setting up your new employees, running the payroll, and then most importantly, dealing with the tax notices, right? Because a lot of the time, payroll processors, they can help resolve certain notices, but not all of them, right? If it's not something that was caused by their service, they will typically not help you resolve it. You can request it, and if they agree, they're going to charge additional fees, and it's not cheap at that point. But there are other, like for example, in our firm, we do have a service called, it's business process outsourcing service for payroll management specifically. In itself, it's not really that expensive. So it starts at about like $99 a month for up to 10 employees. And typically clients say, well, it's really not worth, because I can enter the employee hours myself and run the payroll. But the thing is, we ensure that it's done timely and regularly every time. But then also the biggest benefit is that any tax notices come through, we take care of as part of that service. But, we've had multiple times when clients thought, that was too expensive for their business. $100 a month was too expensive for their business. But then when they start getting the notices, they come back to us. But at that point, obviously, we cannot do it for $99 a month anymore. So it's a different engagement. So that's the value. So with us, or say any other provider or an accounting firm that you're working with, if they're offering payroll management, that's an important item to discuss with them. Will they take care of all the potential tax notices coming through? Because that's going to be the biggest value from that service.
We have a question about, what is the right appropriate time frame? Like if you have an employee saying, I want to get paid faster, or I want to get paid in 5 days, is that normal? What do you have to work with? What's reasonable? Yeah.
So if you're working with a payroll processor, let's take Gusto, for example. Gusto actually gives you an option of how quickly you want the funds deposited in the employee's bank accounts. Because one, it actually allows clients, when they do it set up, is to enter the direct deposit information. So basically they enter their bank account number where they want their paycheck deposited. And then they can download the pay stubs online. So again, that's another thing that the employer doesn't need to do, is cut checks. So it's all done electronically. But then they do allow, so typical payroll processing is 2 days, right? So basically you run it, say, on Wednesday, Friday, the money gets deposited. But they do give an option is to do 1 day payroll run. So basically, you can run payroll the last day on Thursday, and on Friday, the employees will get paid. So with that, if you have to keep track of hours, right, through say the end of the month for every day for your employees, you could literally, the month ended on the 31st, right? On the 1st, you can run the payroll with those hours, and then by the 2nd, your employees get paid. So it's fairly quickly that way. But at the same time, you don't actually have to do it that close. You can run it a little bit sooner, and then when the payday comes, that's when the funds will get withheld from the payroll account and get paid to the employees as well.
Yeah. So it's really
pretty flexible.
Business decision for you on how often you want to run it.
Yeah. So one other important and frequently asked question is, especially new entrepreneurs who want to start a business, is what type of business entity to set it up as. So the first 2 points, I wanted to really just give a broad overview of what types of entities there are available. And then for each of them, I also included, one small blurb. If I ever had to tell a client like only one thing about the business entity type, what it would be. So that's what I put in there. So sole proprietorship is the easiest entity to set up, easiest entity to keep records on, easiest entity to file taxes on. The only bad thing about it is if you're running a business as a sole proprietor, you have unlimited personal liability because your business is you essentially. So you don't even need to register, right? You can go out and just operate it as John Doe. That's it. Or you can register what's called an assumed business name, right? You can call Joe's Construction and then operate it as it. And still, when people write the checks, they can write it, to you or to your assumed name, essentially. So it's very, gives a lot of freedom on how you're operating, but essentially it's also only designed for, sole operator, hence the standard name, sole proprietorship. So then the second type of entity is an LLC. So many businesses form as an LLC. LLC is also very flexible, one of the easiest entities to maintain, report on, and report taxes on, especially when it's just one owner, what's called a single member LLC. So for tax purposes, single member LLC is taxed equivalent to sole proprietorship. The only difference there is that an LLC stands for limited liability company. So it gives some limitation of personal liability. So say if a business was sued, only the business assets would typically be at risk, not owner's personal home and vehicles and other assets. So, but the one thing that a lot of business owners typically are not aware of is that LLC only really exists at state level. There isn't an entity for tax purposes at the federal level called an LLC. It's purely a state level construct. But LLC is a flexible entity in a sense that it can become a partnership, which is an actual entity at the federal level. It can become a C corporation, and it can become an S corporation. It's just you have to file a form with the IRS and take that election for the business. Also, whenever LLC owners are called members, so whenever an LLC has more than one member, and it does no other filings, it by default becomes a partnership for tax purposes and otherwise. So the three entities, partnership, C corporation, and S corporation, they actually require a separate tax return from the business owner. So they actually have to file their own business tax return. Whereas single member LLCs, sole proprietorships, the taxes just get reported on the owner's tax return as on a separate schedule there. So out of the three entities, partnerships and S corporation, even though they file their own tax return, they are not required to pay taxes typically. So they don't pay federal taxes. They will pay, say in Oregon, for example, there is an excise tax, and other states will have their own version of it, which is more of like a standard tax. Like in Oregon, again, it's like $150. That's it. It's not based on how much revenue it's made. It doesn't matter if it was a loss. It's $150 excise. That's it. But typically those entities, they're called pass-through entities, meaning whatever income they earned or losses they experienced, they pass them through to the owners of the business. The only entity that pays taxes itself is a C corporation. So C corporation is therefore typically reserved for large companies, especially the ones that are publicly traded. It's a better structure typically if there's going to be a lot of shareholders, especially shareholders who do not participate in the business. Like basically, if a company has an IPO, it's typically they typically become a C corporation for that.
Got it.
But partnerships and S corporations, they're good options for small businesses. The difference between the two is a partnership. By the way, so C corporations, like I said, it pays income taxes, which is also called double taxation. So C corporations. So because taxes are paid on the same income. First, corporation pays income tax on its income, and then it distributes the income to the shareholders. Shareholders pay taxes on that same income again.
It sounds like that's not typical for a small business, right?
So very, very few small businesses elect that, or elect that by mistake, essentially. Yep. Partnerships, one key attribute of partnerships that a lot of small business owners don't realize, in my experience, is partners should never be on payroll. If you're a partner in a partnership and you put yourself on payroll, that's an error, mistake. It should not be. The reason for that is partnership income is considered self-employment income. It's taxed differently. So if you have employees, they can be on payroll in a partnership, but not the partners themselves.
Got it.
So partnership typically has more flexibility as compared to corporations, meaning you can have two partners who are 50-50 partners in the business as far as contributed capital, but they can actually elect through an operating agreement between the partners, say, to distribute 50% or like say 60% of income or losses to one partner and then only 40 to the other, because say one partner works a little bit more than the other, or whatever the agreement. So there is flexibility in that. But the drawback of a partnership is every partner is liable for the partnership as a whole. So everyone, especially in a general partnership, right? So each partner is severally and wholly liable for the partnership. So, therefore, if you're going to form a partnership, make sure it's somebody you trust or you can trust, right? So that you don't have to answer for somebody else that you never plan to do that, right? So S corporations, on the other hand, are more stringent. If you're 50-50 partners, you cannot split income or losses any other way. It has to be 50-50 because it's based on number of shares owned. But the one attribute of an S corporation is that it can be a tax advantageous strategy. So the quick scenario that I typically run with clients who ask me that question, they usually say, oh, I read this article and said I have to do S corporation because I'm going to save a lot of on taxes. Well, maybe. Or somebody told them that they would, right? So the two scenarios, let's say you're running a single member LLC company and you made $100,000 in net income. So that net income is considered self-employment income. So the first tax that you're going to pay on that whole amount is self-employment tax, which is at the federal level, which is 15.3%. So which equals $15,300 in self-employment tax. After that, you will claim all your deductions on your personal income, income tax return, and then pay ordinary taxes, right? So whatever your tax bracket is. But in the second scenario, let's say that same business elected to be an S corp, and as an S corp, one big requirement that IRS has is if you're a shareholder and the owner of an S corporation, you have to pay yourself a reasonable salary, meaning you have to have yourself on payroll, and you have to pay yourself the same amount you would have paid somebody else if you hired somebody off the market to do the same duties that you are doing. Let's say that reasonable salary, for the example's sake, is $50,000. So you paid yourself $50,000 through W-2 income, right? You paid payroll taxes and everything else. And then you have $50,000 of net income left. So that $50,000 gets allocated to you as a shareholder, but it's not considered self-employment income. So you're not paying that 15.3% in self-employment taxes. And that translates into $7,650 in tax savings, essentially. So, and that's the benefit, right, of the S corporation strategy. One thing to be wary of is it costs money to run an S corporation compared to an LLC. Like like I said earlier, LLC is the simplest entity to maintain, right, and report and file taxes.
Where do the costs come in? Yeah.
For corporations, if you're going to do an S corp, make sure you have accurate accounting, or you're going to have to pay somebody to make it accurate. You're going to have to pay for payroll processor because you're going to have to have payroll, and then you're going to pay additional fees to someone to prepare the business taxes. So, and that can sum up typically for a small business up to about $6,000, maybe plus minus, right? But if you're coming ahead in this scenario, $765, you're still about $1,500 ahead of the game. You're still saving. But if your net income drops much below that, typically for clients, we use a target of around 100,000 net income, then you're not necessarily going to realize tax savings using S corp strategy. So that's kind of answering another question for clients. When is a good time? Well, when your business starts generating at least 100K in net income per each owner.
Got it. That's the benchmark to use. Good.
Yes. Well, it's a generalized benchmark.
Generalized benchmark. Right. Yes. When you're in that ballpark, then yes.
Yes. So, and then the last point for today is when is a good time to hire an accountant as well. So that's a question that we get a lot from the startups. We do talk to a lot of startups. Typically, I tell them that in the first year or two, they should really focus on their sales, because if they're really pre-sale, I would say, if they come to us, I tell them, I give them some pointers of what they can do to keep track of their accounting, especially if they're just a single member LLC, right? It's very simple. I usually tell them, make sure, you don't need to spend your out-of-pocket money right now to keep your books. Because if you don't have any sales, it doesn't matter how accurate your accounting is, right? So I recommend them to put that money towards marketing and business development and make sure that they build up their sales pipeline. Because in a year or two, when they have so much client work or customer work that they don't have the time to keep track of their own books, that's a good time to come and see an accountant, right? Also, even if they made some errors, we can always go up to 3 years back and fix both books and tax filings as well.
Good to know.
So yeah, typically I would say accounting fees should not be a startup expense for most businesses. Tax compliance, probably yes, because you don't want to run into trouble and start paying penalties early on when you can least afford it, right? So it's probably a good investment to have a good tax practitioner to work with. But accounting can wait. So what I also give as far as sort of business hacks for startup owners is make sure you have a business bank account and make sure that you run all your sales and expense transactions through that business bank account. Okay. Don't try to avoid paying for personal expenses with business bank account and vice versa. Try to avoid paying for business expenses with personal banking account. Why is that? Because it's called commingling of assets. You don't want to get into that.
So it's okay if it's in the same. It's okay if it's in the same bank, just in a different account.
Yeah, it has to be an account for the business specifically, because banks, they have, individual bank accounts, retail accounts, and then they have actual business bank accounts. And for business, they'll ask what your business registration is. If you have an EIN number for the business, that's what they're going to use for that. So you want to have it in a completely separate account. And another benefit of that is that if you run a sole proprietorship or a single member LLC, at the end of the year, even if you have no accounting records, all you have to do is just download your transaction ledger from your online banking account, put it in an Excel spreadsheet, sort it. Anything that's positive is going to be your sales, unless it's an amount of money that you put in yourself, right? Owner's contribution, that's not income. So, but anything else positive is your sales for the year. And then all the negative transactions are going to be your operating expenses, which you just need to split up into buckets like rent, insurance, things like that, supplies. Any money that you withdrew for yourself as is owner's draw, that's not an operating expense. So you don't include that. Those are typically not tax transactions. So, but other than that, you pretty much have what you need to file your Schedule C on your individual tax return to file taxes for your business activity. So it's that simple, right? So, and you don't need to pay anyone for that. So that's what we usually give as an advice to, startups, and because it saves them money, kind of keeps them more or less compliant while they're standing up their new venture. So, but another big item is that I try to unpack here on this slide is to give a better understanding of what type of different accountants they are out there, because in practice, I see it quite often that people generally know what a CPA is, but they think every accountant is a CPA, which is not true. There is a considerable difference. So typically you will encounter 3 different practitioners out there for the most part. I mean, there are other certifications as well, but these are major ones, right? So you'll have CPAs, you'll have EAs, which are enrolled agents, and then you have just general accountants who don't have any credentials, essentially. So the thing is that not all accountants are CPAs, but all CPAs are accountants. So out of the 3 categories, CPAs and EAs are the ones that are regulated professions, essentially. So CPA is a profession that's state regulated and federally regulated. EA is a designation that's regulated by the IRS. So they require examination, so they require continuing education. Basically, in order for us to maintain these certifications, we have to, make sure that we, of good moral standing, we have adequate technical training, right? So, and we have to take ethical training, a specific amount of hours every year, and we have to report it all, and we get audited. If we don't do it, we get penalized severely, and we have to pay a lot of fees to keep that up, right? So essentially it takes a lot of effort to maintain. Plus, while EAs, typically anyone can become an EA, all right, there's no other prerequisites. For CPA, there are prerequisites. You typically have to have at least a bachelor's degree plus almost equivalent of a master's degree in college credits. So not anyone can actually just go and get a CPA. Plus, to become a CPA typically requires passing pretty difficult 4 certification exams. So one is general business, second is technical financial accounting, third is taxation and regulation, and the 4th is auditing. Whereas EAs, they typically only pass 1 exam having to do with taxes only, and that's it, mainly tax preparation. So, so that's the difference, right? So when it comes to training in accounting and financial statement analysis, EAs typically are not part of the group. They may have some knowledge just through practical training, but typically it's not part of their designation. So non-accredited accountants can have the training mainly because they took some credits in college maybe. So that's typically how they end up like that. Or, they may have a bachelor's in accounting, so they know enough, but not enough to say pass the CPA exam. So that's the biggest difference. As far as who can help you with payroll, typically you can find accountants in all 3 categories who will be knowledgeable about payroll. CPAs typically will be, accountants maybe, and EAs can as well. All 3 can prepare tax returns, but again, IRS requires certain registration and certain compliance with regulations in order to be able to prepare tax returns. Some accountants who are not accredited, they can know enough to prepare tax return, but the thing is, when we prepare tax returns, we provide audit protection guarantee with each tax return, because CPAs can represent clients in any state in front of the IRS or any state tax agency. EAs can typically do the same at the federal level, but not with all states. But then accountants that are not accredited, they typically will not be able to represent you unless it's a return that they've prepared and they were given authority to represent. So they have a significant limitation there.
So we have a question, Paul, of, some people hire someone to help with accounting on staff, that's not outsourced. What are the typical credentials when they bring somebody in-house?
It will vary. I think a lot of times what's the rate per hour plays a lot into that. But I would say a lot of times you get what you pay for, essentially. I'm not saying that unaccredited accountants are not knowledgeable. I've met many who are very knowledgeable. They're just not accredited. Maybe because they're so far in their career, it just doesn't make sense for them to do it because it doesn't add any value to them or their clients. But then I also met many practitioners who call themselves accountants, where all they've done is took the training on how to use QuickBooks. But when I actually ask them accounting questions, they cannot answer them because they don't know accounting. And the thing with QuickBooks, right? So anyone can get QuickBooks, right? That's, I mean, Intuit, the publisher, they want to sell as many licenses as they can. We see it all the time. Clients think if they got QuickBooks software or subscription, they have accounting. But the thing, it's like in construction industry, right? You can buy all the power tools you want, but if you're not a trained construction professional, you're not going to know how to build a house with it, because you still have to know, right, the code and everything else. It's the same thing with accounting. You can have the power tool, which is QuickBooks, but you still have to know accounting in order to do accounting correctly, because QuickBooks will let you do a lot of things, but it will not tell you if you have correct accounting or not. It's not designed for that.
We have a question back in the first section about financing and where to go if you're going to get financing. Where do you go to find the best terms? What's the best place to start looking?
Well, I'll answer it. It's a good question, because it also reminds me about another tip that we usually give to small businesses when they ask us, which bank should I go and open a business banking account? I usually recommend go with the major bank. Yes, you might be banking yourself in the credit union and you think it's convenient, but trust me, it's going to make your business lives better if you bank with a bigger bank, because bigger banks can also give you, credit cards typically, and you can earn some travel miles, right, or cash back. And guess what? Travel miles or cash back, they're yours. You don't have to declare them anywhere. Just, you can spend on the business expenses, but travel miles are yours. You can use them for personal, needs, and you don't have to, tell IRS about it or anyone, right?
Good to know.
Another hack is major banks. And major banks, we're talking Chase is a good one, Bank of America, Wells Fargo, even US Bank as well, right? So those are the big players. And then there are regional banks that are also maybe a good option. Regional banks are typically good go-tos for financing, but again, you have to be in a good position, right? It doesn't matter what the lender is. Like Umpqua Bank, they're more on the West Coast here, is one of the banks, but then almost every region will have its own regional bank. So those are usually good ones to go and obtain like a term loan through, because they're used to working with smaller businesses, right? And it's typically easier compared to the large bank. You can still do it through a large bank, but you're going to be still a small fish in a large pond there. But as far as banking, like retail banking and commercial banking services, large banks are typically best for that. And they have more importantly, they have the best user interface. Because if you ever banked at a credit union and you log into their online banking, it's very difficult to navigate. Try finding your bank statements there. Try to download your transactions. A lot of times, they'll have available maybe the last 3 months. Well, what if you need the 12 months? Oh, you have to call in and you have to request, and they can only fax them to you. So it's going to make it very difficult for you at the end of the year.
Makes sense.
Major banks, 12 months of back data transactions, no problem. Download on demand anytime. So that's why.
Good. And then
one other hack is if you open a business banking account, they will typically ask you if you want a credit card for your business right away. If you say no, like for example in Chase, right? If you say no at that point, in about a month or two, they will send you an email and say, open a new account with us, and we'll give you $500, $200 bonus, like a savings account. So at that point, go in and open a savings account, collect the $500 bonus, open a credit card, collect $200 bonus, or however many, like 50,000 miles bonus, right? So do it at that point.
So say no and wait for the incentive to come. That makes a lot of sense.
With credit cards especially, right? So a lot of times they will have like an special offer. They will say, we'll give you, 50, 75, 100,000 miles if you put $5,000 on a credit card. What if you have don't have any expenses when you're just starting the business, but say 3 months from there, you have a new project coming up. You need to buy supplies for like $6,000. Perfect timing, right? You go get the credit card, put all that on that business credit card, collect the miles, and then take your family on vacation.
Great advice. So, and thank you, Paul. This is like an incredible overview, and I think good compendium for any small business to have and to go through and to really understand some of the subtleties and decisions that they have to make around finance and accounting. So, very much appreciate you being here. Everybody is saying nice things in our chat, and thank you for your time and for this incredible advice. And we appreciate having you.
Thank you, Liza. I appreciate it.